Chapter 6. The Fate of the Dollar, Half a Trillion Reasons Why the Dollar Must Collapse. The function of the Federal Reserve System is to foster a flow of credit and money that will facilitate orderly economic growth, a stable dollar, and long-run balance in our international payments. The Federal Reserve System, 50th Anniversary Edition, 19631. Introduction. Until recently, the economy of the United States was the one bright spot in a very troubled global economy. Most of the United States' major trading partners are either in economic crisis, attempting to recover from crisis, or verging on crisis. Europe is the only exception. Japan, the Asia crisis countries, and Mexico are all very fragile, and China has a bubble economy just waiting to pop. All of those countries, along with many others, have large and growing current account surpluses with the United States. Their economies have grown dependent on their surpluses with the United States. Economic disaster looms should their exports to the U.S. begin to decline. Consequently, the possibility of an appreciation of their currencies against the dollar represents a grave threat to their prosperity. For that reason, the surplus nations must buy U.S. dollar-denominated assets with the dollars they earn from their current account surpluses, with the United States. The alternative of converting those dollars into their own currencies would cause their currencies to appreciate, their exports to decline, and their economies to collapse into crisis. This dilemma explains why the surplus nations have accumulated such large U.S. dollar foreign exchange reserves over the last 20 years. Their acquisition of trillions of dollars of U.S. dollar-denominated assets also helps explain the stock market boom, the rapid expansion of debt, and the low savings rate in the United States over that period. Now, however, their dilemma is becoming more acute. The U.S. economy has been blown into a bubble because of excess credit expansion. Neither the business sector nor the consumer sector can afford to take on any more debt. In fact, both will soon be compelled to reduce their indebtedness. Similarly, the overinflated equities market is beginning to crash. Under these circumstances, in which U.S. dollar assets will the surplus nations invest their $500 billion U.S. dollar current account surpluses, not only this year, but every year into the future so long as the U.S. current account deficit persists? Those countries will not continue to put $500 billion into U.S. assets every year if they are certain they are going to lose much of it. This chapter will describe why it is becoming increasingly difficult to find so many new, secure investments in the United States. The impossibility of doing so for much longer makes a plunge in the value of the U.S. dollar inevitable. This chapter will begin by taking another look at the United States' rapidly increasing net indebtedness to the rest of the world. Then, it will examine, in turn, the major categories of U.S. investment alternatives available to the surplus nations: debt, equity, and direct investment. The $30 trillion U.S. credit market will be analyzed in considerable detail. Trends in individual debt, financial sector debt, non-financial corporate debt, and U.S. government debt will be analyzed in order to assess the creditworthiness of each of those sectors. It will be shown that only the U.S. government will have the debt servicing capacity to issue the amounts of debt that will be needed if the surplus nations are to recycle their dollar surpluses. However, the magnitude of the U.S. current account deficit is such that not even the U.S. government will be able to issue enough debt to absorb it indefinitely. The alternative investment categories, equities and direct investment, are described next. Equities are shown not only to be overvalued, but also suspect due to the accounting scandals that have undermined trust in corporate America in general and Wall Street in particular. Direct investment remains an alternative, but an illiquid one, not suitable for many of the surplus nations. The wave of defaults on corporate debt and the 50% plunge in the S&P from its peak underline the risks the rest of the world faces in making further investments in dollar-denominated assets. As the surplus nations realize that large parts of the U.S. economy are no longer creditworthy, they will stop throwing good money after bad and, instead, reluctantly convert their dollars into something less certain of producing a loss, whether that be their own currencies, gold, or some other non-U.S. dollar-denominated assets. Then the collapse of the dollar will begin. Part 3 will describe the impact that a plunging dollar will have on the global economy. Financing the U.S. current account gap, $500 billion a year required. It is useful to begin by taking another look at the trend in the U.S. current account balance over the last 2 decades, See Figure 6.1. Figure 6.1 United States, balance on the current account, 1980 to 2001. This string of record-breaking deficits began in the early 1980s, peaking at $161 billion in 1987. The current account deficit shrank as the dollar weakened during the late 1980s, with the account briefly returning to a balanced position in 1991. From 1992, however, the deficit began to widen again, growing steadily worse as the currencies of one country after another weakened relative to the dollar. The peso was devalued in 1994 and the Chinese renminbi the following year, see Figure 6.2. The yen peaked in 1995 and then fell back sharply. In 1997, a severe round of currency instability began as the Asia crisis erupted. Surprisingly, even the euro proved to be weak relative to the dollar after its launch at the end of the decade, see Figure 6.3. Figure 6.2 The violent depreciation of the Chinese yuan, Mexican peso, and Thai baht against the US dollar, 1990 to 2002. Figure 6.3 Weakness in the yen and euro, 1995 to 2002. Naturally, the U.S. trade deficit widened with each of these countries as their currencies plunged, see Figure 6.4. Figure 6.4 Giant sucking sound? The U.S. trade deficit widens with each country as their currencies depreciated, 1990 to 2001. By 2000, the United States' current account deficit had grown to $410 billion, or more than 4% of U.S. GDP. The following year, there was a slight improvement as the overheated economy dipped into a shallow recession. In 2002, the deficit is expected to establish a new record of disequilibrium at almost 5% of GDP. To put that into perspective, the U.S. current account deficit, at $500 billion, will be the equivalent of 1.5% of global GDP. To finance this extraordinary current account deficit, it has been necessary for the United States to attract approximately $3 trillion of foreign investment into the country since 1980. This is reflected in the symmetry between the country's current account deficit and its financial account surplus. See Figure 6.5. Figure 6.5 United States, mirror image, current account versus financial account, 1969 to 98. As a result of its current account deficit, the United States, which up until the early 1980s had been an important source of credit to the rest of the world, is now more deeply in debt to the rest of the world than any other country ever has been. Its transformation from creditor to debtor is illustrated in Figure 6.6, which shows the change in the net international investment position of the United States from 1982 to 2001. Figure 6.6 United States, net international investment position, 1982 to 2001, at market costs. The net international investment position of the United States is a snapshot of the amount that country owes to the rest of the world, or, in other words, the value of all U.S. assets abroad less the amount of U.S. assets owned by the rest of the world. The net investment position of the United States has deteriorated more or less in line with the U.S. current account deficit, because the United States has had to finance that deficit by selling U.S. dollar-denominated assets of one kind or another, stocks, bonds, property, paper dollars, etc., to its trading partners in exchange for their goods and services. At the end of 2001, the net international investment position of the United States was $2.3 trillion, an amount equivalent to 22.6% of GDP. In 2001 alone, the United States' external debt as a percentage of GDP rose 6.6 percentage points, from 16.0% to 22.6%. Over the next 5 years, if the U.S. current account deficits persist at a level equivalent to 5% of GDP per annum, the net indebtedness of the United States to the rest of the world will increase to the equivalent of 50% of U.S. GDP. By 2006, see Figure 6.7. Figure 6.7 U.S. credit market assets owned by the rest of the world, 1980 to 2002, Q1. The blowout in the current account deficit, particularly since 1997, has meant that the foreign share of the ownership of U.S. assets has already risen very sharply. For example, the foreign ownership of U.S. equities increased from less than 7% in 1997 to more than 11% at the end of 2001, while the foreign holdings of privately held U.S. treasuries jumped from 20% in 1994 to 40% in 2001.3. Those large foreign capital inflows had a significant impact on the U.S. economy. For instance, it should be easily understood from the preceding figures that share prices in the United States would have risen less, and Treasury bond yields would have fallen less in the late 1990s in the absence of such large foreign purchases. Because the private sector in the United States is now over-leveraged, it will become increasingly difficult for the surplus nations to find sufficient amounts of new investment vehicles in which to park their dollar surpluses. When they become unwilling to finance the United States' extraordinary current account deficit, the dollar will collapse and the United States will no longer be able to buy $500 billion more in goods and services from the rest of the world than it sells each year. The investment alternatives. The surplus nations must buy US dollar-denominated assets with their dollar surpluses if they are to avoid converting those dollars into their own currencies and killing the goose that laid the golden egg. There are three broad categories of US dollar-denominated assets they have to choose from: credit market, that is, debt, instruments, US corporate equities, and foreign direct investment. Table 6.1 shows where the surplus nations have chosen to invest their dollars each year from 1996. Table 6.1 The acquisition of U.S. financial assets by the rest of the world, 1996 to 2002, Q1, US dollars billion. The table provides a breakdown of the net acquisitions of financial assets by the rest of the world, a figure that amounted to $791.1 billion US dollars in 2001. The net amount of their acquisitions is offset by their net increase in liabilities, $337.9 billion US dollars in 2001, with the result being the net financial investment by the rest of the world in the United States, $453.1 billion US dollars in 2001. The U.S. current account deficit is included at the bottom of the table to demonstrate that the net financial investment by the rest of the world has been sufficiently large to finance the U.S. current account over this period. That, in fact, must be the case. The United States has to pay the rest of the world for their goods and services. To the extent that the U.S. imports more than it exports, it must finance the deficit by selling financial assets to its trading partners. Over the 5-year period depicted in the table, the U.S. current account deficit has increased by 3.5 times, from $121 billion US dollars in 1996 to $417 billion US dollars in 2001. Consequently, the net financial investment into the United States by the rest of the world has had to increase as well. This presents a good opportunity to debunk one of the most absurd ideas ever to circulate in the late 20th century. Government officials and investment bankers frequently tell the public that the U.S. current account deficit is caused by the eagerness of the rest of the world to invest in the United States. They reason that the large U.S. financial account surpluses resulting from foreign investment in the United States necessitate the large U.S. current account deficits, given that the financial account and the current account must completely offset one another when added together. It is hard to understand how such a ridiculous idea could be taken seriously. Americans buy more from the rest of the world than the rest of the world buys from the United States, because the rest of the world uses very low-cost labor to make goods at a much lower cost than US-based manufacturers can. This could not be more obvious. That is why the current account surpluses of Mexico, China, Thailand, and the rest of the Asia crisis countries rose sharply following the devaluation of their currencies. Their labor costs fell, making their products even more attractively priced to the US consumer. Is it conceivable that American consumers buy all the foreign-made products in their homes and in their closets because other countries want to invest in the United States? Or is it because those imported products were 50% cheaper than similar goods made in the US? Wage rates in Chinese factories are $4 US per day. Think about it. In 2001, the United States ran a current account deficit of approximately $400 billion US dollars because the rest of the world can manufacture products more cheaply than the US can. Anyone who tries to persuade the public that the US current account deficit is caused by the desire of foreign investors to buy US assets should be laughed at if he actually believes that and be ashamed of himself if he doesn't. These deficits have resulted in tremendous disequilibrium in the global economy. The public should not be misled about their origin. Figure 6.8 shows how the rest of the world decided to allocate their dollar surpluses between the alternative dollar-denominated investment vehicles available to them. Figure 6.8 A breakdown of net acquisition of U.S. financial assets by the rest of the world, 2001, US dollars billion. In 2001, the United States trading partners divided their net acquisitions of U.S. financial assets between debt instruments, including U.S. corporate bonds, 29%, U.S. government agency securities, 21%, and U.S. government treasury securities, 3%, and foreign direct investment, 20%, U.S. corporate equities, 16%, and others, 10%. The rest of this chapter will analyze trends in each of these asset categories in order to assess whether there will be sufficient security in any of these vehicles, either individually or in combination, to entice the surplus nations to continue investing their annual $500 billion US surpluses in the United States. Debt instruments. Total credit market debt as a ratio of GDP practically doubled in the United States between 1969 and 2001, rising from 152% to 290%. See Figure 6.9. While the trend has been rising almost without interruption every year, there were two periods when the increase in debt accelerated noticeably relative to economic output, from 1982 to 1988, and again from 1996 to the present. It is no coincidence that those two periods corresponded almost exactly to the two worst episodes of deterioration in the U.S. current account deficit. As the surplus nations sought to reinvest their dollar surpluses into dollar-denominated assets, debt issuance expanded to meet that need. Share prices also rose rapidly during those periods, as the rest of the world used their trade surpluses to buy U.S. equities. Figure 6.9 Debt to GDP. Total credit market debt in the United States, 1969 to 2002, Q1. Before we take a more detailed look at the various sectors of the economy that issue debt instruments, consider the following extract from the Bond Market Association's Research Quarterly of August 2002, which will help put the latest trends in the debt market into perspective. New issue volume in the U.S. bond market totaled $2.5 trillion for the first half of 2002, up 16.8% versus the $2.1 trillion issued during the same period last year. Investors found in bonds a respite from poor equity performance, and issuers took advantage of some of the lowest interest rates in decades. Commercial paper outstanding decreased 4.1% to $1.32 trillion at the end of the second quarter, down from $1.38 trillion at the end of the first quarter. Concerns over issuer credit quality have led to a decrease in the use of commercial paper in recent quarters. Issuance of mortgage-related securities totaled $1.01 trillion in the first half of this year, up 5.1% from $664.1 billion issued during the same period last year. Federal agencies increased long-term new issue volume during the first half of 2002 to $453.7 billion. Short-term federal agency debt outstanding decreased 4% to $651.9 billion as of the end of June. New issues of corporate bonds totaled $388.2 billion in the first half of 2002, with volume decreases across all sectors: investment grade, high yield, and convertibles. Asset-backed issuance increased to $237.9 billion, up 6.2% from the $223.9 billion issued during the same period last year. Treasury gross coupon issuance increased 50% to $233.1 billion during the first half of 2002, compared to $155.1 billion in the first half of 2001. Municipal issuance totaled a record $194.6 billion in the first two quarters of 2002. Long-term new issues increased to $164.6 billion and short-term issuance increased to $30.0 billion through June. A great deal can be learned about the U.S. economy by examining these trends in the bond market. As will be seen, this $400 billion 16.8% year-on-year increase in bond issuance in the 12 months up to the end of June 2002, has played the principal role in providing American consumers with the means to continue living beyond their means up until now. Over the following pages, a dissection of the U.S. credit market will show how this was done. The flow of funds. The most comprehensive source of information concerning U.S. debt is published by the Board of Governors of the Federal Reserve System in the Flow of Funds Accounts of the United States. Those accounts provide a breakdown of all debt in the U.S. credit market, in terms of both who owes the debt and who the debt instruments are owned by. Figure 6.10 and Table 6.2 show the rise in total credit market debt from 1980 to the present, and a breakdown of that debt by sector, respectively. Figure 6.10 Total debt in the U.S. credit market, 1980 to 2002, Q1. Table 6.2 Total credit market debt broken down by sector, 1995 to 2002, Q1. The largest debtors are the financial sector, the household sector, the non-financial corporate sector, and the federal government, in that order, see Figure 6.11. Figure 6.11 The major components of U.S. credit market debt, 1980 to 2002, Q1. The two most significant trends here are the rapid increase in financial sector debt throughout the period and the absolute decline in federal government debt at the end of the 1990s. Those trends are put into even better focus when the debt of each sector is shown as a percentage of GDP. See Figure 6.12. Figure 6.12 Sector debt as a percentage of GDP, 1980 to 2002, Q1. As a percentage of GDP, financial sector debt skyrocketed from 20% in 1980 to 93% in early 2002. Household debt rose from 50% of GDP to 78% over the same period. The debt of the business sector rose from 52% to 69%. Even the federal government debt increased from 27% of GDP in 1980 to 32% in 2002 despite the government's uncharacteristic budget surpluses for a few years at the end of the 1990s. The debt of state and local governments and of the foreign sector remained relatively constant throughout the period. The following sections look at the trends in the indebtedness of each of the four largest sectors in order to assess their current creditworthiness. The financial sector. The growth in the debt of the financial sector has been extraordinary over the last 2 decades. Jumping from $578 billion in 1980 to $9.6 trillion in early 2002, the debt of the financial sector in the United States has soared from 21% of GDP to 93%. Equally important, in terms of debt outstanding, the institutions that traditionally supplied credit, commercial banks and savings institutions, have been dwarfed by the rise of federally related mortgage pools, government-sponsored enterprises, and asset-backed securities (ABS) issuers over that period. See Figures 6.13 and 6.14. For example, in 1980, the debt of federally related mortgage pools and GSEs amounted to 4% and 6% of GDP, respectively, while the asset-backed securities market had not yet come into existence. By early 2002, the combined debt of those three groups had risen to 71% of GDP, whereas the debt of the traditional lenders had hardly changed relative to GDP. Figure 6.13 Components of financial sector debt, 1980 to 2002, Q1. Figure 6.14 Components of financial sector debt as a percentage of GDP, 1980 to 2002, Q1. Because the nature of the financial sector has changed so radically over the last 20 years, some description of each of the categories comprising the financial sector is necessary. Federally related mortgage pools. Pools are groups of related financial instruments, such as mortgages, combined for resale to investors on a secondary market. Federally related mortgage pools, as classified in the flow of funds accounts, are pools of mortgage securities issued by the Government National Mortgage Association, Ginnie Mae, the Federal National Mortgage Association, Fannie Mae, the Federal Home Loan Mortgage Corporation, Freddie Mac, and the Farmers Home Administration. The liabilities of federally related mortgage pools have surged from $114 billion or 4% of GDP, in 1980 to $3 trillion or 29% of GDP, in early 2002. Since the beginning of 1999 alone, their liabilities have risen by more than $1 trillion. On the other side of their balance sheets, these organizations hold roughly an equivalent amount of residential mortgages as assets. Although the debt of Fannie Mae and Freddie Mac is not guaranteed by the U.S. government, their bonds trade in the market with a yield that is at a very low premium to Treasury bonds. Apparently, It is generally believed that the government would not allow those institutions to default on their debt should they encounter financial difficulties. In recent years, their size and rate of growth have given rise to a series of concerns regarding these groups, ranging from worries that their government ties give them an unfair advantage relative to their competitors, to fears that their aggressive acquisition of mortgages has fueled a property bubble. Their supporters countered that these institutions have made home ownership more accessible. In any case, by acquiring mortgages, these pools have funneled very large sums into the U.S. property market and, thereby, played a role in pushing property prices higher. The Bond Market Association's August 2002 research quarterly provided the following details. Mortgage-related securities issuance, which includes agency and private label pass-throughs and CMOs. Collateralized mortgage obligations totaled $1.01 trillion in the first half of this year, up 51.6% from the $664.1 billion issued during the same period in 2001. Agency mortgage-backed securities (MBS) issuance increased to $637.6 billion in the first half of the year, up 38.8% versus the $459.5 billion issued during the first half of 2001. Fannie Mae's issuance increased to $311.0 billion in the first half of the year, up 37.2% from the $226.7 billion issued in the first half of 2001. New issue volume of Freddie Mac MBS totaled $240.4 billion in the first two quarters of 2002, up 52.8% from last year's first half volume. Issuance of Ginnie Mae MBS increased 14.2% in the first half of 2002 to $86.2 billion. Issuance in the agency collateralized mortgage obligation (CMO) market increased to $241.0 billion in the first half of 2002, more than doubled the $111.5 billion issued during the first two quarters of 2001. Freddie Mac CMO new issue activity totaled $148.7 billion, up from the $71.9 billion issued last year during the same period. Additionally, CMO issuance volume of both Fannie Mae and Ginnie Mae increased during the first half of the year. Fannie Mae issuance increased to $58.4 billion, up from the $22.2 billion issued during the same period of 2001. Issuance of Ginnie Mae CMOs almost doubled to $33.9 billion when compared to the $17.4 billion issued during the first half of 2002. Every asset price bubble requires credit as fuel. The preceding paragraphs make clear the origins of the credit that is fueling the U.S. property market bubble and, by extension, the consumer spending spree in the United States. Government-sponsored enterprises. At the end of the first quarter of 2002, the liabilities of government-sponsored enterprises amounted to $2.2 trillion, up more than $1.1 trillion since the end of 1997. Those liabilities are comprised primarily of GSE debt instruments. The GSEs that are included in the Federal Reserve's flow of funds accounts are in the Federal Home Loan Banks, the Federal National Mortgage Association, Fannie Mae, the Federal National Mortgage Association, Freddie Mac, the Farm Credit System, the Financing Corporation, the Resolution Funding Corporation, and the Student Loan Marketing Association, Sallie Mae. Their assets are comprised of U.S. government agency securities, including those of Fannie Mae and Freddie Mac, 46%, mortgages, 13%, corporate and foreign bonds, 6%, and loans to one another, 23%. In other words, these institutions issue bonds and use most of the proceeds to make loans to or buy bonds from other GSEs. Issuers of asset-backed securities. The most striking explosion of debt has been that undertaken by issuers of asset-backed securities, ABS. The ABS market only began to develop in the early 1980s, but it has grown at a remarkable rate since then. Debt owed by issuers of ABS surpassed that owed by commercial banks for the first time in 1990. Less than 12 years later, their debt exceeds that of commercial banks by almost 4 times. By early 2002, the assets and liabilities of the issuers of ABS had grown to $2.2 trillion. Their assets are comprised of mortgages, 42%, consumer credit, 27%, trade receivables, 11%, agency securities, 13%, and other loans and advances, 7%. ABS are made up of a pool of assets such as mortgages, credit cards, auto loans, equipment leases, corporate loans, trade receivables, etc. Originators, such as banks and leasing companies, pool groups of loans and sell them to special purpose vehicles, SPVs, which, in turn, issue ABS to investors. ABS offers several advantages to the originators of the asset pools. First, selling those assets to SPVs reduces their risk-weighted assets and thereby frees up their capital, enabling them to originate still more loans. Next, it lowers their risks. In a worst-case scenario where the pool of assets performs very badly, the SPVs would pay the price of bankruptcy rather than the originator. Finally, the originators earn fees from originating the loans, as well as from continuing to service the assets throughout their life. In other words, securitization enables the originators of the loans to enjoy most of the benefits of lending money, without bearing the risks involved. Those risks are shifted to the institutional investors who acquire the ABS and the funds they manage. By removing loans from the banking sector, the development of the ABS market has also reduced the contingent liabilities of the government, which, through the Federal Deposit Insurance Corporation, FDIC, insures the bank's depositors. However, at the same time, those risks are shifted back to individuals whose pension accounts would take a hit in the event of large-scale defaults in the assets underlying the ABS that are held in their retirement account and mutual funds. The economic slowdown is likely to expose such weakness, particularly since subprime home equity loans have become the fastest-growing sector of the ABS market in recent years. There are growing concerns that ABS have given rise to moral hazard on the part of those who originate and sell the repackaged loans. Figure 6.15 shows a breakdown of outstanding asset-backed securities by major types of credit. Figure 6.15 Asset-backed securities outstanding by major types of credit, 2001 US billion. Commercial banks. One rule of thumb should always be kept in mind regarding credit quality: it always appears high at the peak of the business cycle. So long as credit expansion continues, borrowers have no trouble repaying their loans, even if they have to take out new loans to pay back the old loans. Only when new credit begins to dry up does credit quality deterioration begin in earnest. It would seem that the U.S. credit market has just passed that watershed. Credit expansion is slowing and bankruptcies are beginning to blow out. The total loans of commercial banks contracted in the first quarter of 2002 relative to the previous quarter, albeit by only $2 billion. That was the first quarterly contraction in lending since the first quarter of 1997. Relative to the first quarter of 2001, lending increased by 1.6%. Banks lent generously to individuals, but curtailed their commercial and industrial loans. Loans to individuals increased by $52 billion, or 8.7%, compared with 1 year earlier, while commercial and industrial loans contracted by $78 billion, or 7.5%. Thus far, consumers have shown greater resilience in the face of the economic downturn than have corporations. The continued rapid expansion of consumer credit is the principal reason why. As will be seen below, both sectors are in trouble. Banks will either continue to rein in credit or soon wish they had. Bank balance sheets are in for a retrenchment. They are unlikely to issue much new debt of their own as they call in loans to their clients. Foreign investors will have to look somewhere other than commercial banks if they are to reinvest their dollar surpluses. The rest of the financial sector. Little explanation is required for saving institutions other than to point out again that, as with commercial banks, the relative stagnation in their level of debt to GDP is largely explained by the development of the ABS market, which has enabled these groups to shift assets and liabilities off their balance sheets and into special purpose vehicles. The others category depicted in the preceding figures is comprised of credit unions, life insurance companies, finance companies, mortgage companies, REITs, brokers and dealers, and funding corporations. This category is relatively small, equivalent to only 14% of GDP. Also, it has not grown relative to GDP over the last 20 years. For these reasons, no further comment will be made about these institutions. The financial sector, concluding remarks. The debt of the financial sector has grown much more rapidly than that of all other sectors of the economy over the last 2 decades. Within the finance sector, federally related mortgage pools, GSEs, and ABS issuers have grown at an extraordinary pace and now dominate the sector. The health of these groups cannot be considered independently from the health of the overall economy. Consumption has held up remarkably well in 2001 and 2002 despite the economic downturn and sharp slide in share prices. Many observers believe that the consumer's resilience is explained by the continuing aggressive extension of credit by the financial sector in the form of mortgages and consumer credit. Rising joblessness, stagnating wages, the loss of stock market wealth, and a historically low savings rate all suggest that the financial sector will find the quality of their assets deteriorating rapidly during the months and years ahead. That process is already well underway. As the deterioration of their asset quality accelerates, they themselves will be perceived as less creditworthy and will find it increasingly difficult to issue new debt of their own. In an environment of generally deteriorating credit quality, foreign investors will be reluctant to provide further credit to the financial sector in the United States. The household sector. If the U.S. economy has been the engine of economic growth in the world in recent years, it has been because the American consumer has been in the driving seat and speeding. The household sector's credit market debt amounted to $7.9 trillion at the end of the second quarter of 2002, making it the second heaviest borrower in the credit markets after the financial sector. As a percentage of GDP, this sector's debt has risen rapidly to 77%, from 50% in 1980, enabling the American consumer to fuel the global economy. Record low interest rates and wildly aggressive lending practices by creditors have allowed households to continue increasing their debt and their consumption. However, the deflation of the new paradigm economic bubble has caused unemployment to rise, while knocking down the rate of increase in personal income to the lowest level in more than a generation. Moreover, the U.S. stock market crash has erased $8 trillion in wealth since March 2000. The ratio of consumer debt service payments to disposable personal income is climbing quickly toward a new record high, and personal bankruptcy filings have already set a new benchmark. Equally disturbing, the personal savings rate very nearly became a personal savings rate in 2000 and 2001 at the peak of the boom. As these issues were described in some detail in Chapter 5, no further analysis is required here to conclude that the finances of the American household sector are rotten. They can only be expected to worsen as the economy and share prices weaken further. Households will have no choice but to borrow less and to repay part of what they currently owe. Foreign investors would be wise to reduce any credit exposure they might have to this sector. It is very unlikely that they would consider the debt of this sector as an attractive investment opportunity. During the next several years, see Figure 6.16. Figure 6.16 Household Sector Credit Market Liabilities, $7,800 billion in 2002 Q2. The non-financial corporate sector. The story in the corporate sector is quite similar to that of the household sector: reckless borrowing and mind-boggling capital misallocation. The debt crisis in the corporate sector was described in the previous chapter, so a brief summation of the facts will suffice here. In the second quarter of 2002, this sector's credit market debt amounted to $7 trillion, or 68% of GDP, up from $1.5 trillion, or 53% of GDP, in 1980. The corporate sector's liabilities are comprised of corporate bonds, 54%, bank loans, 17%, and other loans and advances, 14%, see Figure 6.17. That is, of course, if their accounts are to be believed. With new scandals and revelations of every type of corporate shenanigans dominating the front page of the newspapers week after week, there is every reason to suspect that this sector has drastically understated its liabilities, while there is absolutely no justification for extending yet more credit to the sector. The U.S. commercial banks reduced their commercial and industrial loans by $78 billion, or 7.5%, in the first quarter of 2002 relative to 1 year earlier. A full-scale credit crunch crisis is now besetting the sector. Corporations must now reduce their liabilities. Many of them will have no option but to do so in the bankruptcy courts. Foreign investors purchased $161 billion in U.S. corporate bonds in 1999, $183 billion in 2000, and $231 billion in 2001. In light of the losses that those investments must have generated, the surplus nations are very unlikely to consider U.S. corporate bonds as the investment vehicle of choice for recycling their dollar surpluses in the years immediately ahead. Figure 6.17 Non-financial commercial business credit market liabilities. $4,866 billion in 2002 Q2. It can be seen in Figure 6-18 that the increase in total credit market debt slowed despite surging Treasury bond sales during the last recession in the early 1990s as private investment fell and the growth in personal consumption expenditure slowed to a crawl. The same patterns will hold during this recession. Credit market debt will not expand sufficiently to allow the reinvestment of the surplus country's dollar surpluses. Figure 6-18 Investment, consumption, and credit in the United States, 1981 to 2001. % change. The U.S. government. Out of all the major sectors issuing debt in the U.S. credit markets, the U.S. government is the least overextended financially. Thanks to 2 tax increases in the 1990s and surging capital gains tax revenues during the new paradigm bubble, the federal government achieved a budget surplus for 4 straight years, beginning in 1998. Although many in government might hesitate before signing affidavits swearing to the accuracy of those accounts, in light of the treatment of contributions to Social Security. Those fiscal surpluses put an end to a long string of budget deficits that added $3.1 trillion to the government's publicly held debt between 1980 and 1998. Consequently, the ratio of government debt held by the public to GDP declined from 50% in 1993 to 33% in early 2002. In absolute amounts, the government's publicly held debt peaked in 1997 at $3.8 trillion before falling back to $3.4 trillion in 2001. Now, however, the budget deficit is back, thanks to the recession and the stock market crash. The Office of Budget and Management has forecast a deficit of $165 billion in 2002 and $109 billion in 2003. Events are likely to prove the estimate for 2003 to have been wildly optimistic. As the economy slows further and share prices continue their slide, tax revenues will be considerably weaker than currently anticipated, while expenditures, augmented by additional spending to mitigate the impact of the slump, will be considerably higher. By 2004, it is quite probable that the budget deficit will exceed its old record of $290 billion set in 1992, and continue to deteriorate from there. A large new supply of Treasury bonds may be the salvation for the dollar in the near term. The United States trading partners will leap at the opportunity to invest their dollar surpluses in bonds with the full faith and backing of the U.S. government. The surplus nations need approximately $500 billion worth of sound investment vehicles each year, in which to invest their dollar surpluses. The prospects that such large amounts of sound credit instruments could be found within the financial sector, the household sector, or the non-financial corporate sector are not at all promising given the factors highlighted earlier in this chapter. Therefore, a large U.S. budget deficit could not occur at a more opportune time from the perspective of the surplus nations. However, to what extent, and for how long, will the budget deficits satisfy the requirements of the rest of the world for secure dollar-denominated assets? At present, the foreign holdings of privately held U.S. Treasuries come to 40% of the total outstanding. Such a large holding of treasuries by other countries could be viewed as something of a security risk by the U.S. government. For example, should other countries decide to sell treasury bonds aggressively into the market either for economic or political reasons, a great deal of turmoil could arise in financial markets in the United States and around the world. For this reason, it seems realistic to assume that the foreign holdings of all new treasury issues are unlikely to exceed 50% of the total. Under those assumptions, budget deficits as high as $500 billion would only provide half of the new supply of dollar-denominated assets the United States trading partners need. The other $250 billion would have to be found within the U.S. private sector. That would require the surplus nations to find $1 trillion of sound investment vehicles in the U.S. private sector over the next 4 years. If they are not willing to risk $1 trillion in private sector investments over that time horizon, then the dollar must decline sharply as the dollar surpluses of the surplus nations are converted into other currencies. Scenarios other than the one outlined above are conceivable. However, it is hard to imagine any realistic combination of events that would support the dollar at its current level for very much longer. For example, a budget deficit of less than 500 billion US dollars is quite possible, but that would mean that the surplus nations would have to find a larger amount of secure investments in the private sector, which would be quite tough. On the other hand, a much larger budget deficit, say of 800 billion US dollars or more, is not inconceivable, but a deterioration of the budget of that magnitude would imply a very serious economic collapse, which would mean even fewer sound private sector investments. Finally, a systemic crisis in the banking sector or a collapse of one or more large GSEs would bring about an immediate upsurge in the supply of treasury bonds, but would inflict extraordinary losses in other parts of the credit markets. In the best case, then, it would appear that increasing U.S. budget deficits may provide part of the safe, dollar-denominated assets the rest of the world needs and thereby relieve part of the pressure on the dollar. However, the supply of government bonds is likely to be too small to discourage dollar selling or else so large as to imply crisis elsewhere in the credit markets. A temporary reprieve arising out of higher budget deficits is, realistically, the best scenario imaginable for the dollar, even under the best circumstances. Equities. The rest of the world bought 194 billion US dollars in US corporate equities, at the top of the market in 2000 and another 129 billion US dollars in 2002. Between March 2000 and mid-July 2002, the S&P 500 index fell 48%, inflicting great pain on US and foreign investors alike, see Figure 6.19. Approximately $8 trillion US dollars in wealth was destroyed in crashing US equity markets during that period. Figure 6.19 Dow Jones Industrials, 1970 to 2002, monthly averages. 2 points may be sufficient to show why the US equities market will not be considered a safe place for the surplus nations to invest their dollar surpluses in the years ahead. First, the market capitalization of US equity markets has fallen by $8 trillion US dollars since they peaked in early 2000. They do not as easily absorb hundreds of billions of dollars of foreign investment as they once did. Second, equities remain very overvalued by historical standards. Between 1900 and 1990, the average price-to-earnings (PE) multiple of the S&P index was less than 15 times historic earnings. In mid-2002, after its 48% collapse, the index is still trading on 30 times historic earnings. Yes, investors should base their calculations on a company's prospects rather than its past, and therefore consider prospective earnings rather than historic earnings. However, given the ongoing revelations of accounting fraud among an extraordinary number of previously reputable companies, and the slumping economy, a further sharp fall in earnings seems at least as probable as a sharp earnings recovery. See Figure 6.20. Figure 6.20 price-to-earnings multiples for the S&P 500, 1986 to 2001, based on year-end prices and historic earnings. Once the virtuous upward spiral of the bubble expansion within an economy gives way to the vicious downward spiral, earnings evaporate very quickly. That process, in large part, accounts for the 75% decline in the Japanese stock market and the 88% collapse in Thailand's stock market, following the implosion of their bubble economies. With the S&P down only 48% and the Dow Jones Industrial Index down only 30% from their highs, U.S. shares remain overvalued and are likely to fall considerably further and then remain depressed for years to come. The surplus nations would be well advised to invest their surpluses elsewhere. By the way, when the U.S. stock market crashed in 1929, it fell 88% before it bottomed. It did not recover to its 1929 high until 1954, 25 years later. See Figure 6.21. It does not always pay to buy on dips. Figure 6.21 Dow Jones Industrial Average, 1920 to 55, monthly close. Foreign direct investment in the U.S. The remaining major investment category available as a receptacle for the rest of the world's dollar surpluses is foreign direct investment into the United States. There has been substantial foreign direct investment into the U.S. in recent years. The amount rose as high as $301 billion US dollars in 1999, before falling back to $158 billion US dollars in 2001. Foreign investors will continue to buy companies in the United States. However, the extinction of the .coms, the fiasco in the telecommunications industry, the scandalous behavior of some of the largest banks, and the risks arising from the conflicts of interest within the accounting profession have undermined confidence in the American business model. These factors are likely to cause investors from other countries to think twice before making a direct investment in a U.S. company. The slowing U.S. economy will also make the earnings prospects of most direct investment targets less attractive than before, which will further deter foreign investors. Finally, most investors prefer liquid assets that can be sold quickly and with little effort. The assets to be acquired through direct investment are therefore not acceptable to the majority of would-be foreign investors. Moreover, some of the countries with large current account surpluses with the United States may feel that directly investing in a liquid real assets in the US is too risky from a political point of view. China, which now has the largest trade surplus of any country vis-a-vis the US, could fall into that category in light of its history of turbulent relations with the United States. For all the reasons cited above, the United States trading partners are likely to make fewer direct investments in the US in the years immediately ahead instead of making more. Conclusion: the dollar is destined to collapse because the US economy will soon no longer be able to generate a supply of secure US dollar-denominated investment vehicles sufficiently large to enable the rest of the world to recycle its annual $500 billion current account surplus. The countries running large current account surpluses against the United States need to continue buying US dollar-denominated assets to avoid converting their dollar surpluses into their own currencies. Conversion would cause their currencies to appreciate and their exports to decline, throwing their economies into crisis. To avoid that scenario, the surplus nations have to buy either existing US dollar-denominated assets or new dollar-denominated assets as they are issued, because the amounts involved are approaching the equivalent of 5% of US GDP. If the surplus nations buy existing assets, they will drive up their prices from already inflated levels and thereby fuel new, unsustainable asset price bubbles in the US. On the other hand, in light of the current economic crisis and the weak financial condition of many of the largest businesses, very few U.S. corporations are likely to be able to bring substantial new debt or equity issues to the market in the near to intermediate term. Only the U.S. government will have the debt servicing capacity to issue large amounts of new debt over the next 5 years. The fate of the dollar in the near term may hinge on how quickly and by how much the U.S. budget deficit widens. Very large deficits exceeding $500 billion annually would supply the secure dollar-denominated assets needed to recycle the rest of the world's dollar surpluses. Even that, however, would only give the dollar a temporary reprieve. Not even the U.S. government could sustain budget deficits of that size indefinitely. The international monetary system is unstable. Because the post-Bretton Woods system has no inherent adjustment mechanism to ensure balanced trade, giant trade imbalances have arisen. As explained in Chapter 1, those trade imbalances are flooding the world with liquidity and generating excessive credit creation. Even if the dollar does not crash immediately, that does not mean that the global economy would stabilize, even temporarily. So long as the dollar remains at or near its current levels, the U.S. current account deficits will continue to generate unsustainable asset price bubbles and deflation around the world. Those very undesirable side effects are the subjects of Chapters 7 and 8.